How's it going, everyone? Welcome back to the Crunching Numbers YouTube channel. Today we'll be taking a look at bonds within accounting, specifically just going over the basics of bonds, accounting for bonds that are issued at discounts and premiums. Then in this video, I'll just be going over a broad overview of these bond basics, some important terminology that you'll need to know when completing bond questions, and of course going over examples later on in the video. If you want to skip ahead and just see those examples, I'll leave a timestamp below for you. But whether you're studying for the FAR CPA exam or in a intermediate accounting class, then knowing bonds and going over the bond basics is especially important. So with that being said, let's jump right into the video. Just going over some of the bond basics here. Bonds are basically issued by companies to obtain large amounts of capital for their business needs. Now, what exactly are bonds? Well, all they are is that they represent a contractual promise between a company and an investor in which the company receives a sum of money up front from said investor and then promises to pay back that investor a sum of money at a later date, say with or even without interest payments. Now, there's a couple different types of bonds, just going over them very quickly here. There's debentures, which are unsecured bonds, collateral bonds, which are secured bonds, mortgage bonds, which you can guess are backed by real property, convertible bonds, which can be converted into common stock, term bonds, which have a single fixed maturity date where the entire principal is paid off on that date, and of course there's also zero coupon bonds in which the bonds are sold with no stated interest rate. In order to understand the basics surrounding bonds and in order to answer questions relating to bonds, here's some must-know terminology. First, we have face or par value. This is just the total dollar amount of the bond. It's the basis in which the interest is to be paid out. Next is the stated interest rate, also could be called nominal or coupon interest rate, just the actual interest that's to be paid out to investors. Next, the market interest rate, or sometimes referred to as effective interest rate. This is the interest actually earned by the investor. It's also used to calculate the price of the bond when different from the stated rate, and we'll actually see this later on in an example later in the video. Next is discount. So this is when the market rate of interest is actually higher than the stated rate. So when the price is actually lower than that of the face value, i.e. when the company receives less funds from the bond instead of its face value price. Next, we have a premium. Now, this is when the market rate of interest is lower than the stated rate. So the price or money that the company receives when issuing that bond is actually greater than its face value. And then we've gone over some of the bond basics as well as some of the important terminology. Let's jump right into our first example here, going over how to calculate bond price as well as any interest payments. So the question, Forge Inc. issued a 10% $500,000 bond due in 5 years' time. Bonds were issued January 1, year 1. Interest is due on July 1st and December 31st. The market rate of interest is 10%, and it gives us a list of present value factors there, which we will be using in determining the bond price. However, let's first take a look at the questions here. They're asking us to calculate 1, the interest payment of the bond, as well as 2, price of the bond. So focus on the first one here, interest payment of the bond. First, it gives us in the problem the face value of the bond, which it says is $500,000, as well as it says it issued it at 10%. Now, whenever it gives you the face value and what percentage they issued at, that's its stated rate. So in order to find the annual interest, all we're going to take is that face value, which was $500,000 given in the problem, multiply it by the stated interest rate, which is 10%, and we get $50,000. However, keep in mind this is the annual interest payment, and if we take a look at the question, it says interest is due on July 1st and December 31st, so they're paying out interest across 2 periods. So if this $50,000 amount is our annual interest period, we have to divide it by 2 periods because they're paying interest twice to get each interest payment at $25,000. Now just remember here, count for how many times interest is paid during the year. Next, it asks us to find out the price of the bond. Now in order to do this, we're going to be using these present value factors here. In order to find out the price of the bond, we basically want to take the face value of that bond and multiply it by its corresponding present value factor, as well as take the interest payment and multiply that by its corresponding present value factor as well. So in order to figure out which one to choose for the face value of the bond, $500,000, you're either going to choose the present value of $1 at 10% for 5 periods given here, or the present value of $1 at 5% for 10 periods. Well, in order to choose the correct one, we're just going to see how many times interest is paid out during the year, which we already know in the problem it's paid out on July 1st and December 31st every single year, so 2 times per year. And the bond is due in 5 years' time. So over the course of a 5-year period, each year interest is paid out twice. So we multiply the 5 by 2, and that's across 10 periods, which is given right here. And basically the market rate of interest here, which is given at 10%, we're going to want to divide that by 2 to get 5%. So interest is paid twice, so you would multiply the time period by 2, and you would divide the market rate of interest percentage by 2 as well to use the present value of $1 at 5% for 10 periods, and its corresponding present value factor is 0.613913. So if we take a look at our solution here, present value of the face value, it's just $500,000, face value of the bond, multiplied by its corresponding present value factor, 0.613913, and we get $306,957. However, to calculate bond price, we need to add that to the present value of interest payments. So if we take a look at our question here, for the interest payments, we're going to use its corresponding present value of an annuity, and again, at the 5% for 10 periods since interest is paid out twice. Again, just remember, if interest is paid twice, we multiply the time period by 2, as well as divide the market rate of interest by 2. So that's corresponding present value factor is 7.721735. Again, taking a look at our solution here, we're just going to take our interest payment of $25,000, multiplied by its corresponding present value factor of 7.721735 to get $193,043. Now again, to find out the bond price, we're just going to take those two numbers there, add them together to get $500,000. Now just keep in mind here how the stated rate of 10% equals the market rate of interest at 10%. Whenever these two numbers equal, the price that is sold for the bond will always equal its face value, which you can see here. Price is $500,000, which equals the face value of the bond. So jumping into our second example here, what do we do if the bonds are issued at a discount? So, reading the problem, Nora Corporation issued a 10% $900,000 bond due in 5 years. The bond was issued on January 1, year 1, with interest due every June 30th and December 31st. The market rate of interest is 12%, and of course it gives us a list of corresponding present value factors. Quickly taking a look at what it's asking us to calculate. 1, price of the bond. 2, discount of the bond. And 3, journal entry to record bond issuance. So focusing on the first one here, price of the bond. Well, in the problem, it gives us that the stated rate is 10%, and the face value of the bond is $900,000, as well as interest is due every June 30th and December 31st. So just keep in mind, interest is paid out twice a year. So right off the bat, you're going to want to calculate for your interest payment. So jumping to our solution here, taking that face value amount of $900,000, multiplying it by the stated rate of 10% to get our annual interest payment of $90,000. However, keep in mind, we're paying out interest twice during the year, so divide that by 2 periods. So each interest payment comes out to $45,000. Next, we want to calculate the present value factors for the interest payment as well as the face value to determine the price of said bond. And with this, we know we're using the market rate of interest. However, keep in mind interest is paid twice during the year. So we take our market rate of interest at 12% and divide that by 2. So we know right off the bat we're using the 6% present value factors. And the bond is due in 5 years, so multiply that by 2 for 10 periods, and we know we're using the correct ones here. So in order to find out the price of the bond, we're going to take our face value of $900,000 and use this present value of $1 at 6% for 10 periods, which is, the present value related to that is 0.558395. Next, for the interest, we're using the present value of annuity at 6% for 10 periods, and the value corresponding to that is 7.360087. So again, jumping back to the solution here, take your face value of $900,000, multiply it by its corresponding present value factor, and we get the present value of that principal, which is $502,556. Likewise, take your interest payment, multiply by its corresponding present value factor, and we get the present value of the interest payments, which is $331,204. And again, in order to determine the price of the bond, we're just going to add these two amounts together, so the $502,556 plus the $331,204 to determine the price of the bond at $833,760. Now, jumping to the second question here, determining the discount of the bond. All this is taking your face value of the bond, which again is given in the problem at $900,000, subtracting out the price of the bond, which we just determined to be $833,760, to arrive at our discount of $66,240. And just keep in mind, whenever the market rate of interest is higher than the stated rate of interest, as you can see here, 12% is the market rate, which is higher than the stated rate at 10%, it will always result in a bond discount. Finally, going over the third question here, the journal entry to record the bond issuance. Well, we're going to debit cash for the price of the bond, which we determined to be $833,760, because that's the amount of cash that the company is obtaining from the investor to obtain this bond. Next, we're going to want to debit out the discount on the bonds payable, which again was the face value minus the price of the bond, which is $66,240. And the bonds payable will always be the face value of said bond. So credit bonds payable, $900,000. Now going over our last example here, example 3, what to do if we issue these bonds with a premium. So reading the question, James Corporation issued a 10% $225,000 bond due in 5 years. The bond was issued on January 1, year 1, with interest due every June 30th and December 31st. The market rate of interest is 8%, and of course it gives us a list of corresponding present value factors here. Just looking at what it's asking us to calculate: 1, the price of the bond; 2, premium of the bond; and 3, journal entry to record bond issuance. So, just like the last example, in order to determine the price of the bond, first we start out by calculating our interest payment. So in our question, it gives us a stated rate of 10%, as well as a face value of the bond of $225,000. And again, always keep in mind how many times interest is paid out during the year, which here it says June 30th and December 31st, just like in the last example. So jumping to our solution, in order to figure out our interest payment, we're going to take the face value of said bond of $225,000, again multiplied by our stated rate 10% to get our annual interest payment, our annual interest of $22,500. Now, in order to find out our interest payment, we want to divide that by the number of times interest is paid out during the year, which in this case is 2, to find out each of our interest payments at $11,250. Now looking at the question, it says our market rate of interest is 8%, which we already know we're going to use that to determine which of the present value factors we're going to use to calculate bond price. So since the market rate of interest is 8% and we're paying out interest twice over the course of a 5-year period, we know we're going to take 5 times 2 to get 10 periods. So we know we're going to use either of these with 10, which they all show 10. However, we're going to take the market rate of interest and divide that by 2, since we're paying out interest twice a year, to get 4%. So we know we're using the ones with 4% and 10 periods. 4%, 10 periods. So in order to calculate the bond price, again, jump into our solution here, we're just going to use that corresponding present value factor. So the face value of $225,000 multiplied by its corresponding present value factor, which was given on the previous slide of 0.675564, to arrive at the present value of the principal of $152,002. Next, to find out the present value of the interest, just take our interest payment, which we already calculated at $11,250, multiplied by its corresponding present value factor, which again was on the previous slide that I highlighted, to come to our present value of interest at $91,248. And of course, to figure out the price of the bond, we're just going to add these two amounts together to determine the price of the bond to be $243,250. Now looking at question number 2, to figure out the premium of the bond, all you're going to do is switch this formula around than when you calculated for in order to figure out a discount. First, you're going to take the price of the bond now at $243,250 and then subtract out the face value of said bond at $225,000 to arrive at the premium of the bond of $18,250. Now, taking a look at our last question here within this example, again, the journal entry to record bond issuance. Well, remember, we're going to debit cash for the price of the bond, which we already calculated to be $243,250. When it's a premium, we're going to credit that premium on bonds payable for the amount $18,250. And always remember, the bonds payable amount is always the face value of said bond. So credit bonds payable, $225,000. And that pretty much wraps the video on bond basics. As long as you have a good understanding of the overview of bonds that we went over, the must-know terminology of bonds, as well as the examples described within this video, then you should have a very, very good understanding of bonds and know how to solve a majority of problems given to you on your homework assignments as well as your exams. Again, I'll leave you with a question of the video. In example 2, if interest was paid only on December 31st, what would the price of the bond issued be? Remember, leave the answer to that question below in the video. I'll pin the first comment that I see that's correct at the top. Of course, leave in the comment section below also what videos you would like to see in the future, as well as topics I should go over. And with that, I hope you liked this video, and I hope everyone has a good one.